Hello and welcome back to the Library of Mistakes for bank regulation. Just a couple of things to mention. We have film night next week when we have Trading Places, which some of you may remember. If you're not old enough to remember it, you're in for a surprise. Time has not been kind to some of the wording in Trading Places, but it's still funny as hell. So please join us for Trading Places next week. Also, we now have a membership. This is a free public library, open 9 to 5, Monday to Saturday. So once you've registered, you can arrange a visit. You can come for free. But there are now some additional services available if you want to pay £120 for an annual membership. And that will allow you to come here really when you want, rather than having to arrange a visit, free tea and coffee, discounts on courses, etc., etc. But just to stress, we are still a free public library. I'm standing here looking down to the back of the room, reading a billboard called Britain's 500 billion bailout special edition. And that is there because I picked it up the morning after the banks went bust. It was a news seller at the corner of London Wall and Moorgate, and he gave it to me for nothing. But the reason I mention it is we're here to discuss bank regulation. There was a time when all anybody wanted to talk about was bank regulation in the aftermath of that great mess. Times have moved on. Today, the government, Bank of England, changed some of the regulations on bank capital needs in the United Kingdom to try and free up more capital. So one feels like we've been through kind of a long cycle. But I'm delighted to introduce Sean. He's a senior lecturer in financial history and policy at the University of Glasgow. I've read the book, as you can probably tell. It's a tremendous read for a book on bank regulation. Actually, it's just a tremendous read non-stop because it's peppered full of vignettes of banks through the ages and their successes and failures. We have copies for sale at the end as well. So Sean will talk about the book, the history of bank supervision, this fusion between public power and private finance. And then, as usual, we'll go to the Q&A. Sean.
The mic seems to be working, so thank you, Russell, for that. Thank you, David, for all your work organizing this, setting it up. I'm going to start by being a bad guest, which is by saying that Russell talked about this as a history of bank regulation, and in fact, it is not. It's a history of bank supervision, and those are different things, and you'll learn about that difference in a moment. When we started working on this book about 10 years ago, bank supervision was a niche topic of interest perhaps to a few US legal academics, but not much more widely than that. In recent months, though, the Trump administration has appointed Michelle Bowman as the vice chairman of supervision at the Federal Reserve. Bowman's vision of supervision, along with or in line with the Trump administration's effort to roll back the federal government, is focused on maybe sharpening supervisory attention, on shrinking the workforce dedicated to bank oversight. And that has had some commentators really worried, at least in the New York Times, that this effort to cut back oversight is likely to have significant consequences for financial safety in the United States. It might. It might also transform the U.S. commitment to a system of financial oversight that's global, right? So we have this, these Basel agreements on bank supervision. We have these global capital rules that are meant to apply across the largest banks in the banking system. Bowman is in line with kind of an arc of U.S. policy, really pulling the U.S. back from that. And so this topic of bank supervision, which had been very niche up until recently, is now, if not front page news, is significant news as we're thinking about where we are in the financial cycle. So we might be kind of in a Minskian arc from a speculative to a Ponzi finance. We might be thinking about allowing U.S. banks to cash in while the going is good. We may also just be freeing up banks to pursue legitimate innovation. And it's hard to really know until the history happens, and then someone will write a book on it, and it will be on these shelves. The book that we wrote, my co-author Peter and I, is a history of bank supervision in the United States, essentially from the founding in the 1770s until the 1980s. 80s. In my talk today, I'm going to talk first, I'm going to frame the book, talk about some core concepts, talk about some large themes. Then I'll narrate very briefly the history that we try to cover in the book before looking at, again, some kind of important implications for the present. Now, when people think about bank oversight, they often think about a few key institutions. They think about legislation. So what are the rules that Congress in the United States creates to govern the financial system? They think about the National Banking Acts in the 1860s and the Federal Reserve Act in 1913. People think about bank regulation. So what are the rules that govern banking, whether they come from legislation or then written by regulatory agencies like the Federal Reserve. But up until recently, they have tended not to focus on bank supervision as a distinct set of institutions, a distinct set of practices of financial risk management in the present undertaken by public officials. And so the goal of the project was really to try to understand bank supervision on its own terms as a set of practices that sometimes supports or is in alignment with the rules and sometimes goes its own way. Now, talking about supervision requires then defining bank supervision. So the Federal Reserve, on a periodic basis, publishes something called the Purposes and Functions of the Federal Reserve System. And this is just like a book-length, publicly facing document that tries to explain what it is that the Federal Reserve does. And if you look up bank supervision in the most recent one of these, which I think is from 2024, you'll see this helpful infographic. At the top is kind of what I talked about at the beginning. This is a process of creating rules. Congress enacts a law, a regulatory agency writes an initial draft, it goes through a public notice and comment period, and then there's a final rule that's created. At the bottom then is how the Fed explains supervision in the present. And over again, at least in this infographic, the Fed defines supervision as enforcing or determining or ensuring compliance with the rules. So the Fed is trying to help us see supervision as simply a continuation of this rule writing process. We write rules, and then we evaluate institutions' compliance with, or we ensure institutions' compliance with the rules. And so you can be forgiven for thinking about supervision as narrowly about compliance. But if we look to the past, the Fed in the past offered a much more expansive and active definition of supervision. So this is the same section from Purposes and Functions of the Federal Reserve from 1954. And this is the paragraph that defies easy infographic making that the Fed provides. And I'm just going to try to read from my very small text here that you can read here. So supervision includes issuance and enforcement of supervisory and other regulations, organization and chartering of banks, periodic examination of banks, requiring of steps by bank management to correct unsatisfactory or unsound conditions, the review and analysis of periodic reports, the rendering of counsel and advice, especially to smaller banks, et cetera, et cetera. So we see this transformation, or in at least the way that the Fed is explaining what it does. Supervision as compliance to supervision as a much broader set of practices aimed at ensuring or managing the risks of the financial system. And we can tell some different stories about this difference. It might be that supervision has simply changed from a very active vision of government oversight of the financial system to one that's very narrowly focused on compliance. It could be actually that supervision has stayed the same or even expanded in its scope, but because of maybe political considerations, it's important for the Fed to frame supervision as compliance. It could be a number of explanations. But the point is that as finance has evolved and changed from the 50s to the present, supervision has as well. And the point of the book is to try to understand those changes. We take up, in that sense, three key themes, which I'll explain in a moment. So one is public versus private, one is rules versus discretion, and one has to do with institutional evolution, institutional development, institutional layering. So first, public versus private. The essential question that we're interested in is who bears the ultimate risks of the financial system, And then how do you manage those risks, given that, given whether it's the public or the private? So within the US financial system, private banks create money, private banks create credit. Private bankers have a profit motive that encourages them to maybe create more money or more credit than is socially optimal. Obviously, financial crises are not socially optimal. There are costs not only for private bankers, for society at large. But prioritizing public risk management has challenges as well. Often the goals that the public might have in terms of safety and soundness can mix with other goals, political goals such as competition policy, anti-discrimination. And so the scope for oversight and management for the financial system can shift from purely financial risk to a much broader set of risks that have to do with, again, kind of social and political causes. And so the question then is, how do you balance? And how has the balance evolved over time between these public and private methods of risk management? The second key theme is rules versus discretion. So do you want a financial system where there are a set of clear and bright line rules that bankers have to follow? Or do you want a financial system where those rules are interpreted by either public or private officials as, the markets transform, evolve, and change, as financial institutions transform, evolve, and change, especially as bankers creatively or innovatively shift their business models to avoid or circumvent the rules. And we can imagine different configurations. You can imagine a system where you have very strong rules and no discretion, which could really limit the options available to bankers. You can imagine a system where there are relatively weak or indefinite rules and a lot of discretion, which opens up opportunities for innovation, but also a lot more public power, a lot more official discretion, chances for uncertainty, unfairness, capture. Or what critics worry that the current Fed is drifting towards is a system of weak rules and weak supervision. The third theme of the book has to do with institutional evolution and is in part a historical argument about how institutions change and a constitutional argument within the kind of peculiarities of the US political environment, where the original purpose of Congress or of other law creators really matters. So one way to think about institutional creation and development is a sort of Big Bang theory, right? Where an institution is created, the Federal Reserve is created in 1913, its original kind of purposes and functions were set by Congress in a particular moment, and that institution then continues, those purposes and functions continue over time, unchanged. We can imagine, by contrast, a process of evolution where, and this is really the argument that we come down on, institutions are not set in stone. That policymakers are, and Congress intends them to be evolving as the financial system evolves. In a system of often punctuated equilibrium where institutions evolve slowly and then very quickly as crises take place, as innovations take place that policymakers must respond to. So we see a kind of, am I on the wrong slide? Big Bang, right, equilibrium. I was trying to be really slick and not look at my slides, and that's the price that one pays. You could also let me know. Just like Sean, you're on the wrong slide. So change, where we have this process of punctuated equilibrium, evolution is slow and then it's fast. And then we also track this process of institutional layering. So in the United States, you often have supervisory institutions that match up with a kind of risk management ethos or a risk management set of processes. So the Comptroller of the Currency, which is created in the 1860s, uses chartering and charter enforcement. The Federal Reserve uses central banking and liquidity. The Federal Deposit Insurance Corporation, so 1930s, uses deposit insurance. We get something called the Reconstruction Finance Corporation, which uses public ownership as its risk management method. And these different institutions exist simultaneously. And either they're in competition with each other or they're in cooperation with each other, but there's always this process of layering new institutions onto what's come before. So history really matters in the way that bank supervision is constructed. Initially, when we were writing the book, we wanted to call it the banker's thumb, which is an allusion to Stephen Jay Gould, who's an evolutionary biologist. And Gould has this famous essay called The Panda's Thumb. And the argument of the essay is that, there's no divine intelligence to evolution, and evolution doesn't lead towards sort of greater and greater perfection. Anyone who knows anything about U.S. kind of banking agencies knows it's just a kind of chaotic mix of different institutions that no grand designer or deity would plan, but it's functional. Gould's argument about the panda is that over time the panda grew an elongated wrist bone that functions as a thumb and enables the panda to eat bamboo. It's not that pandas are good at eating bamboo. They spend lots and lots of time eating bamboo. But it works well enough. And part of what we're trying to understand is how this institutional evolutionary process, it didn't yield a perfect system, but within the American political context, it yielded a functional system. And that's what we're trying to explain. So that leaves us ultimately 4 key insights about bank supervision in the United States. So first is that supervision is about the relationship between individual actors in government and individual financial institutions. And this is where the rubber meets the road in terms of government oversight of the financial system. Second, supervision is further defined by an evolutionary process that is resistant to efforts to impose any single defining ethos. So, for example, we have different institutions with different risk management functions, whether it's central banking with liquidity, deposit insurance, et cetera. And if you look at the system overall, none of these particular risk management ethoses win out over time. They're always in contest. They're always evolving. The third point is that this leaves supervisors and ultimately the US Congress to use supervisory discretion to choose among competing conceptions of what this individual relationship between government and private bankers will mean. And fourth, this system has proved resilient to change, and so it's amenable to expansion because supervisory discretion functions as a risk absorber for the entire financial system. So how did we get this way? Now we shift to the history part. In the United States, when it was founded, most banks were chartered at the state level. And if you think about the arc of the early Republic period, so from the 1780s through to the 1860s in the Civil War, most innovation around financial oversight happened at the states. There were experiments with chartering and charter enforcement. There were experiments with central banking. There are experiments with different kinds of liability insurance, so not just deposit insurance, but banks are issuing their own notes, as they still do in Scotland. Those were sometimes insured. And there are experiments with forbearance, so when banks would get into trouble, supervisors would relax or briefly not enforce the rules to try to let banks work things out themselves. And so you could see this process of institutional evolution at the state level unfolding through the 1860s, but once you get the Civil War, and the US government needs to finance the war, there's then a new effort at consolidation. Policymakers like Samuel Chase, who's Secretary of the Treasury, John Sherman, who's a major Republican senator, want to renationalize the banking system. And through the National Banking Acts, which is 1863 and 1864, they create a robust system of federal bank chartering, and they try to create a robust system of bank supervision. And over the 1860s, this evolves into a system where federal policymakers are actively trying to shape the banking system, to shape bank lending to support both the northern economy, but also northern political economic goals. They're trying to encourage bankers to practice safe and sound banking. They have an entire vision of kind of a federal government and private bankers holding hands and promoting a positive banking system. The problem is it doesn't really work. It's really hard in the 1860s to oversee banks. Just imagine riding a horse from town to town in western Pennsylvania and trying to instruct bankers on safe and sound banking. It's just not functional. Bank examiners during this period are very susceptible to corruption. There's one guy who rips off a bunch of banks, essentially finds bad information about them when examining them, coerces them into giving him loans for this project he has out in Michigan to build a canal that doesn't go anywhere. Ultimately, the Panic of 1873 exposes the fact that Well, the comptroller of the currency, who's the federal supervisor at the time, can charter banks and can oversee banks. The comptroller doesn't have a balance sheet. The comptroller can't provide liquidity when banks need it most. And so after the 1870s, there's a transition from a very public vision of bank oversight in the United States to a very private vision. The New York Clearinghouse Association becomes the lender of last resort and functions with more or less success in that role until the 20th century. The comptroller of the currency essentially says it's up to bank directors to supervise their banks. Directors have liability if the banks fail, so we're going to shift all of this onto the private sector, and the public sector is going to gather information. It's going to give advice, but ultimately it's up to private actors to oversee the system. Now, if you know anything about US economic history, you know the late 19th century is just a series of financial panics, one after another after another. And so by the turn of the 20th century, it's clear that the supervisory system as designed is not working. There are two big options on the table. One is deposit insurance. One is central banking. Central banking wins, and so into the 1920s, we have two institutions. We still have the comptroller of the currency. Actually, we have three. The comptroller of the currency, we have state-level supervisors, because states have begun chartering banks again. So you have thousands of state charter banks. You have as many supervisors as you have states. And then you have the Federal Reserve layered on top of this, providing liquidity to its members. There's a lot of competition between the Fed and the comptroller. There's a Federal Reserve president who's actively trying to eliminate the comptroller of the currency through much of this period. And again, this competition is not good for bank stability. So the 1920s, you have a large and long-scale agricultural crisis. Thousands of rural banks that are not members of the Federal Reserve are failing. And then with the Great Depression, the kind of solution that both the comptroller and the Fed arrive at is forbearance. The idea is that, the Depression is a one-off. The banks are fundamentally sound. Asset values have gotten out of alignment. And so there's an effort to kind of forbear, let the system right itself, and everything is going to work out fine. That doesn't work out. And this is the kind of pivot from the book. We have this period of experimentation through the 19th century. There's this contest between public and private, between federal and state, between comptroller and Federal Reserve, between deposit insurance and central banking. With the Great Depression, we have this kind of critical moment. As I said, from 1929 through the 1932 election, Herbert Hoover and his supervisors are trying to forbear. They're trying to show strength by not closing banks and hope that as the economy recovers, the banking industry will recover. But that doesn't work. And so after Roosevelt is elected, there's a series of state-level bank holidays, so state governments close their banks. And when Roosevelt assumes the office of the presidency in March of 1933, he closes all the banks. And what Roosevelt does is he promises the American people that in a week's time, when the banks reopen, no unsound bank will reopen. And he's on the radio, and I love to do this with students because you can play the radio address, you can dim the lights, and you can ask them to imagine yourselves as a family in a household with your savings in a bank, listening to the president over the radio promise you that although everything has been failing up to this point, when the banks reopen, they will stay open. And so that moment, Roosevelt promises safety and soundness to the banking system, and when the banks reopen, people stop taking money out of the banks and start putting money back in. And the question is, why does that happen? And one answer that people often give is that it's just Roosevelt, right? This guy has the juice, right? He has enough charisma, has enough political power, has enough of a mandate to promise this and people to believe it. I think that's doubtful. Another way to think about it is maybe it's just the technocratic expertise. Roosevelt promises that there will be common sense checkups of the banking system. He promises that they're going to be inspected. And so maybe it's just that technocracy that's enough. But Hoover had tried that. Hoover is a celebrated technocrat, and that didn't work for Hoover. And so ultimately, it's this combination of politics and supervisory legitimacy. So the supervisors have been collecting information about banks this entire time, through call reports, through examinations, through the Fed inspecting banks' books to value bank assets. The federal officials knew which banks were sound and which were unsound, but they'd been trying to keep them all open to maintain faith in the system. Roosevelt gives them the power to show strength through closing some banks so that you know the ones that reopen are safe. And so it's that moment when there's this ambiguity up until Roosevelt about who is going to bear the risk of the All right. Yeah. So, yeah. It's this moment when it's unclear whether it's going to be the private bankers, their private institutions, including clearinghouses, or whether it will be the public that ultimately bears the risk of the financial system. And it's in the bank holiday that it's clear that it's the public and the federal government in particular that stands behind the banks. And so to then actualize that, you have this process during the New Deal, right, during Roosevelt's administration, where you take the promise of the federal backstop and you turn it into institutions. You have the Federal Deposit Insurance Corporation, which comes online in 1933. You have a strengthening of the Federal Reserve System in 1935. You have something called the Reconstruction Finance Corporation, which purchases direct ownership stakes in more than 5,000 US banks. So you have risk management through ownership. The RFC is picking board members for these banks. It's actively managing them as a beneficial owner. And so there's this real transformation in the way that supervision and risk management is operating. Now, certainly there's conflict. The heads of these agencies all hate each other. They're at war through the entire 1930s. But the system stabilizes. And more than that, it kind of works. Banks stop failing. Now, certainly it helps that after World War II, the American economy is an enormous growth engine. But what we then see or track through the rest of the book is a new process of institutional layering where it's that success at keeping the banking system safe and sound that encourages Congress to give bank supervisors new responsibilities. First, it has to do with competition policy. So supervisors want big banks because big banks, in theory, are diversified and are safer. Congress, motivated by a kind of continuous anti-monopoly streak in US politics, doesn't want big banks. But ultimately, Congress gives supervisors both very visible authority and active discretion over anti-monopoly policy through the Bank Holding Company Act and then subsequent bank merger acts. And then on top of that, Congress, given the rise of social movements in the United States in the 1960s, adds new anti-discrimination authority, so fair housing, trying to stop banks from discriminating against black home buyers, and then consumer protection and anti-discrimination on the basis of gender, so things like truth in lending, things like equal credit opportunity, things like community reinvestment. There's this constant process of giving these supervisory agencies, who of course through examination can look as deeply into banks as you might want to look, these new authorities that often the supervisors don't want and actively resist. And so we then have this arc where there's experimentation in the 19th century. Will it be public? Will it be private? Will it be state? Will it be federal? To a clear solidification of federal authority during the New Deal, and then this sort of working out of the institutional layering, both new supervisory institutions, new supervisory and risk management processes, deposit insurance, ownership, and then new responsibilities like competition policy and anti-discrimination. And so then the question is, maybe what are the stakes today? And often when we talk about this book, when we think about this project, when I talk about like what Michelle Bowman at the Fed is thinking in terms of supervisory reform, we hear arguments against robust discretion in bank supervision. So one is just the idea that government officials will never know the business of banking as well as bankers do. And I think this is problematic, first, because supervisors' whole job is to go to many banks to see the business from a variety of different perspectives. And so often supervisors do know quite well, and then they often get very high-paying jobs in the very banks that they're supervising. But it's also a kind of non sequitur. The supervisor's job is not to know the banker's business. The supervisor's job is to supervise the bank, is to determine its safety and soundness. And so you can think about this as like maybe you have kids, maybe you have teenagers who know how to use technology more effectively than you do. But maybe if you're an adult, you might be able to evaluate the safety of social media or of AI, that you're able to think more critically about it. You may not understand the underlying technology, but you can take a larger perspective. And that's often the way that supervisors are approaching risk management. The second issue often, especially in the US context, is that supervision violates the rule of law. So supervision is discretionary. It often takes place in private, in bank offices. Supervisors are making decisions on case-by-case basis, trying to look at a variety of different aspects of a bank's business. And so you, within financial oversight, don't often have bright line rules. You have discretion. And that can look a little bit strange from a rule of law perspective. This is often underspecified, and it can be true, but throughout the history of US supervision, supervision is and has been discretionary. That's how it works. And any rule that you define, you're always kind of getting at smaller and smaller gradations of discretion in defining whether that rule is being complied with or not. Finally, and this is a kind of maybe a critique of the supervisors themselves, often there's this assumption that supervision has to operate at the highest degree of confidentiality. So if you're researching bank supervision, it's very difficult because most supervisory material is now classified as confidential supervisory information. You can't access it through a Freedom of Information Act request. And so it's very difficult to then evaluate whether supervision is effective or not. If you take, for example, the recent crisis around Silicon Valley Bank, the narrative around that crisis is that Silicon Valley Bank showed a gross failure in supervision because the supervisors weren't able to convince bank executives that their enormous investments in long-dated treasuries were poorly timed given the impending increase in Federal Reserve interest rates. A different way to view that story is that only Silicon Valley Bank and a handful of crypto banks failed. And so maybe it's a story that supervisors across the American banking industry successfully advised bankers to move out of long-dated treasuries or other positions that would be impacted by a rise in interest rates. And it's only one set of bankers who are obstinate enough to crash their bank into a hillside. We just don't know because there isn't available public information about the supervisory process. And you can kind of understand this because you need this confidentiality to have these close relationships between public officials and private bankers, but there also needs to be some sense, of public accountability that's balanced with that. So in any case, that's the book. Thank you for coming, and I look forward to chatting with Russell about it and to your questions.
Thank you, Sean. Just bring that signal for a bit so
Yeah.
you're in shot. So I started covering American banks in 1990 as an analyst, and the first thing that shocked me is just how many of them there were. And I think maybe your bank explains why, but what was it that Americans had against branch banking? Is that the reason why there were, I think when I started, there were tens of thousands of banks? Is that why there were so many? And what was seen as so evil about banks having branches?
I mean, I think there's an inherent suspicion in the United States about concentrated both public and private power. And so really beginning in the 19th century, you see this huge war against, there's an experiment in central banking. You have something called the First Bank of the United States. It has a 20-year charter. The charter expires and the bank ends. Then you have the Second Bank of the United States, which ignites this enormous political controversy. Maybe you've heard of Andrew Jackson, one of our most violent and famous presidents, and he literally went to war with the Second Bank of the United States. and killed it. And a lot of this has to do with, again, concentrations of power being antithetical to the American ideal of sort of states, of state power, of states' rights, of local power. And so we really end up in a model, and there's also maybe some institutional arguments about like why we end up in a system of unit banking, but that's what we mostly have, where a bank has a charter, it's chartered in a single location, it has a single office. Within states, you may eventually get branch banking, but before really the 1980s, it's still impossible to cross state lines. So some states might still have unit banking, some might have statewide banking, but you don't have nationwide banking until the 90s. And it's really, I think, tied up in this ethos of local democracy, local governance, local economic and political power.
So this is the Hamilton versus Jefferson debate.
Entirely.
It's kind of ironic that the musical was written about Hamilton. He was the great man for bigger banks, almost immediately after the great financial crash.
Ooh, yeah. I think situating Hamilton in relation to the financial crisis is pretty interesting.
Yeah. So there's some lovely little stories in here. Can you tell us why it's important for well, in the 19th century, how it's important for bank examiners to look at the depth of ski or sledge tracks in the snow that were in front of them as they were moving from town to town to look at the next bank?
So we tell this story in the bank, which Russell is obliquely referencing, where, supervision is hard in the 19th century. And so in Michigan, in the 1830s, they create a system of bank chartering where any private entrepreneur that wants to start a bank can charter a bank. And within this, they create the requirements that the banks have reserves in specie, so gold and silver coin. And they create bank examination to ensure that those reserves are there. And with the bank examiners, as they're traveling from town to town in the winter in the 1830s in Michigan, which is barely settled at this point, is they always see, as they go from town to town, these deep tracks in the snow. And what they come to realize is that there's this sled that's moving from bank to bank, depositing the coin in the bank just long enough for the supervisors to see it, to count it, to ensure the reserves are there. And then the bank examiners go to bed, and the sled goes on to the next bank. And it's a way to illustrate, right, that it's really difficult in this period to undertake the kind of public oversight that officials are imagining. And that bankers are very creative in ways that they're going to circumvent the rules. And in the end, this means that most of the Michigan banks fail in rather spectacular fashion. But it shows how then supervisors from that point forward are trying to stay one step ahead of, but tend to often be one step behind the silver sled, as we call it.
Silver sled. I want to talk about A.P. Gianni because obviously today we have banks with branches everywhere, so there's an evolution to that. Can you talk about Gianni and how he tries to jump the hurdles that allow him to become this different type of bank, and maybe who he was as well, because he's a very interesting character.
So A.P. Giannini is an Italian immigrant. He starts a bank in San Francisco. He really thinks of himself as a people's banker. He's really interested in banking households before this is very common. So if you think about just the name commercial bank implies this is a bank that takes deposits from and makes loans to commercial businesses. And in the sort of, really from the 19th century forward, you have other kinds of banks, savings banks, that are focused on household savings. But Giannini is trying to combine these things. He comes to fame after the San Francisco earthquake and the Great Fire of San Francisco because he just keeps the bank open and lending to households through the catastrophe. And then he sets out to build a banking empire in California. So California allowed statewide branching, and he just takes this to the full limit. He's opening banks, he's buying banks, he creates a bank holding company. He begins, through the holding company, buying banks across the West and even into the East Coast. He really imagines, on a sort of Canadian or European model, creating a truly nationwide bank. And in part, this makes sense, right? Just like imagine unit banking in the United States. You're a banker in Kansas. All of your customers are wheat farmers. You have one bad wheat crop and you're done, right? You're toast. So you're undiversified. Giannini has this vision of like what diversification and household finance can mean at scale. And he is also enormously powerful. So California is a huge state. Giannini goes out for Roosevelt, and because he has 2 million customers across California, he controls California. And so that's where you get this tension. There's small bankers who are terrified of Giannini because he's either going to buy them out or, worse, open a branch in their town and outcompete them. You have politicians who are terrified of Giannini because he can get out votes, because he has the deposit base, because people in this time period are actually going to the bank all the time, right? And the Fed is terrified of Giannini because they can very quickly imagine that he'll be bigger than they are. That actually, like, the central bank is going to be much smaller in comparison. And once you get the FDIC, Giannini is a bigger risk to the Federal Deposit Insurance Corporation than the smallest 5,000 banks put together. And so there's this enormous tension between a vision of big banking as safe banking and all of the kind of like competition, risk management, and political worries rolled into one. And so there's this constant tension or constant fighting between Giannini and the various state and federal supervisors throughout this period.
Well, you have a quote here from the state superintendent of banking who argued that the empire was too big to supervise and beyond any public power to control.
Yeah.
Rings a bell with where we are. But how did we get from, we can't let him get too big because we can't regulate him, he'll be too powerful. Post-war period, more bank holding companies, fewer and fewer banks, more and bigger banks. What was the regulatory change, institutional change, or maybe even ethical change that permitted the concentration of power that Americans had long resisted in the pre-World War II era?
It's a long process. I think the supervisors always see some size as beneficial. We want some consolidation because we think bigger banks are safer. But initially, this is often thought about like at the city level. We're going to have 2 banks merge in Philadelphia. Will that bank be too big for Philadelphia? And it's this kind of constant push. Part of what they try to do is stop what Giannini was doing. So once you have a bank holding company, your holding company can own banks, but it can also own insurance companies or industrial businesses. We talked about a salmon cannery that Transamerica, which was Giannini's holding company for Bank of America, owned. So in the 50s, Congress tries to kind of divide banking and commerce. You can have a bank holding company that owns lots of banks, but it can't own other stuff. Or you can have a one bank holding company that owns one bank and some other stuff. Over time, banks then innovate around these rules. One is they internationalize. So Citibank is a key example of a bank that can only build branches in New York, but has 200 branches across the globe and develops a lot of capabilities about booking transactions to the most profitable source, innovating around or circumventing regulations. You have a kind of internationalization story. You have this desire for economic growth after the 1970s and that crisis. You have sort of state-level deregulatory efforts where you get states agreeing to allow branch banking, like Georgia will let Florida banks come to Georgia if vice versa happens. So there's this kind of creeping, chipping away at this fear about size that eventually gets us into things like nationwide branch banking. It gets us to the repeal of Glass-Steagall, the repeal of this division. But it's a very incremental process, in part because bankers are capable of playing the long game. They have an end goal, which is removing all of these barriers, but they find ways to slowly chip away.
And at no stage, I think, has Congress ever successfully pushed back against that and reduced the concentration. Have they? Was there any period, particularly post-World War II, where they were strong enough to say you have to get smaller rather than bigger?
I mean, again, I think Congress is really, well, there's two things. One, Congress isn't a specialist institution, so they don't have enough expertise often to drive these changes. I think they recognize that they want some size because they see the risk of small banking. You could say that the New Deal is a moment when this happens, right? That given the crisis of the Great Depression, it's clear we should just consolidate the small banks. We should get rid of the small banks. Mariner Eccles, who's chairman of the Federal Reserve, calls them mushroom miscalled banks. He says he uses the word Holocaust, I think before the Holocaust, to describe the destruction of small banks during the Depression. And he says, this is the problem, we have to get rid of them. But the whole reason we have deposit insurance in the United States is to preserve small banks, is to make it safe to put your money in a small bank. And that retains this unit banking system. And so I think the New Deal is a moment when you could have gone towards bigness, but they don't. And then there are these moments with the Bank Holding Company Act, where they break up Transamerica, they break up Giannini's empire, where they do shrink things down, with bank merger legislation. But it always gives the power to the supervisors. And the supervisor's preference, I think, tends to be for bigger banks.
Okay. Do we call that regulatory capture or, supervisory capture?
I think probably no, not at first. But right? I think they see it as promoting safety and soundness. They see unit banking as fundamentally unsafe. They would argue that, if you're a bank manager and you're a good bank manager, you're not going to work for a small town bank. And so the banks are not only undiversified, but they're poorly managed. And so if we can get them just big enough, we can have good management, but not too big that they are, as the California bank superintendent, unsupervisable. That's the kind of happy medium. Then I think there's a transformation after the 1980s. We stopped in 1980 because we didn't want to make things hard for ourselves, and we didn't want the book to be too long. But that, I think, is when the ideology shifts. And to the extent that sort of both its ideological capture in that this preference for bigness, this preference for universal banking really takes hold within the supervisory institutions as well as within the banks. And so that's where, everything gets rolled back.
I was thinking Mariner Eccles would know about mushrooming. He was one of 21 children, so he probably had a bit of experience.
Well, his father was Glaswegian, actually.
That's right, and he was a Mormon missionary in Glasgow, so he toughened him up, I think, a bit. All these big decisions in the Fed today are still made in the Mariner Eccles building, so his legacy continues. So the great takeaway from the book is how this peculiar banking system, I think it has been shaped by all of this legislation over the years. Do you want to make any forecasts? I mean, you sort of started there with a little bit of changes in supervision, but can you foresee a time when, in a public policy perspective, that the people of America demand some of these behemoths are smaller, which they have done before, albeit quite a long time ago? Or are we in just a constant drift towards greater concentration in banking?
Yeah, I think, right, it's hard to envision a policy change that breaks up the banks. I think it's easier almost to envision nationalization, like a true crisis. And then maybe once you've nationalized the big banks, you can imagine breaking them up. But it's harder to imagine doing it through a process of taking a public institution or a private institution and breaking it up. I think the challenge too that we have is like trying to imagine what banking is going to look like in a decade or 2 decades. What big banks were doing is building branches everywhere, and now they're closing all their branches. And this is happening in the UK. It's happening in the US, right? This consolidation where the footprint of banks is getting smaller and smaller. And so that could, in theory, open the door for new digital banks. I use Starling. I'm not sure why, but I thought this would be kind of cool, use a digital bank. But it's not clear to me that they can compete with JP Morgan. And if JP Morgan wants to take them over, it will. And so it really will take dramatic change to decide, okay, this is the limit, and you will not get bigger than this.
Well, maybe if someone writes a musical about Jefferson, the zeitgeist, it'll be a sign that the zeitgeist has changed and we're reversing the concentration. That's enough questions for me, I think. Do we have any questions from the floor? At the back.
Jumping to current date, Sarbanes-Oxley, you've not mentioned it yet. My observation, both personally and in my job previously, it has a big effect on our world. How does the U.S. implementation of Sarbanes-Oxley have a global impact, and why? I mean, I think it's absurd, but nevertheless, it happened.
So I'm going to punt because the book ends in 1980. But I would ask you, actually, so unpack that question.
Like you, I have an American accent. I am unable to open a bank in this country. And in the U.S., I'm unable to open a bank in their country, where my citizenship is. So it's like, why? Sarbanes-Oxley. Because of the rules and regulations that are imposed by the bank inspectors, blah, 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 blah. So I'm kind of stuck. So I'm not trying to make this personal, that's not my point, but the effect is that, like it or not, what happens in the U.S. moves internationally. And I'm not sure that's a good thing, but nevertheless, I understand why it's happening.
I guess I think it's also interesting, so it's definitely true that bank chartering after the financial crisis falls off a cliff. It's at zero. And so there is maybe a question of how much of that is Sarbanes-Oxley and how much of that is excessive supervision of chartering. In theory, a bank charter is just something that you say, okay, well, I meet the requirements, I get a charter. But it's supervisory as well. The supervisory institutions they decide, yes or no, you get a charter. I think another way to look at it, right, is that most of the big banks, if you want a bank, why would you start a new one? Just buy one. So there's a way, whether it's a public or a privately owned bank, that you can just take over an existing bank, and that might be easier, and it might have fewer supervisory hurdles. And so to some extent, restrictions on bank chartering following the crisis makes sense, just in a standard, whenever you have a crisis, you get a tightening of supervision, and that can affect chartering as much as lending oversight or anything else. There may be aspects of Sarbanes-Oxley that I don't have an answer to that may also play into it. But there are thousands of banks in the U.S., and it seems like, entrepreneurs who want to use banks as a depository institution for their crypto scheme have been successful in identifying banks and taking enough of a stake in them to use them in that way. So I just think you're not being creative enough or aggressive enough in your desire to own and operate a bank.
We have a book in here, the subtitle of which is Why Rob a Bank When You Can Own One?
Yeah.
And that has happened throughout history. In fact, just over here we have a little savings bank from the Franklin National Bank, which collapsed under suspicious circumstances in the 1970s, owned by a man from, I don't want to be too frank about this, but owned by a man from Italy.
Well, it was also one of the first credit card banks. In Long Island, they created a whole local credit card network, precursor to, Visa and MasterCard. So it was a really important bank, collapsed, as you say, under suspicious circumstances.
So there's lots of supervision. But you're suggesting it's not that difficult to get control of a bank, and lots of dubious characters have over the years. Yeah. Is that how you subvert some of this?
Well, I think, again, it just depends on part of what you see is, and what I started the talk with, is that personnel can really shape how supervision is undertaken and how serious it's undertaken. So we have a whole chapter about this guy, James Saxon, who's comptroller of the currency beginning in the Kennedy administration. And so Saxon takes this position after this post-war period of financial restraint, where the idea is that we're going to keep the banks safe and sound, we're going to limit their risk-taking. And Saxon comes in and he says, no, what we need is economic growth, we need more bank charters, we need more bank risk-taking. And so he really tries to open up bank chartering to anyone who wants a charter. Now, the problem is that then people take him up on him. So there's this guy named Silverthorne who worked for Giannini at Bank of America. Silverthorne gets a bank in San Francisco, accepts massive bribes to make dubious loans, does all kinds of, tries to bribe supervisors by giving them cases of whiskey, which I don't know, is probably pretty effective. And his bank collapses in spectacular fashion. And this is really the club that that Saxon is pummeled with is like, well, you open this up and there's this one bank failure because this one guy who shouldn't have owned a bank. And it raises this question, which is just perennial. How much risk-taking is too much? Okay, we want our banks to take some risk. How do you draw the line between too much risk? And that's a question that U.S. supervisors never and will never solve. It's always this pendulum swing back and forth.
Yeah, we have another question.
Yeah, I got, it's a personal question. I got the feeling early on when you were debating regulation and discretion that your leaning was towards discretion. And I just wonder if your personal view has changed in the recent past with the arrival of a certain you-know-who in the United States who loves the word discretion. I mean, that's music to his ears to be just, to use his discretion, his personal discretion for everything across the globe. Has that changed your view on the banking situation with regards to discretion and regulation?
So I guess what I would say is that as a normative question, I wouldn't say that discretion is better. What I would say is that when we don't look at supervision, we miss the importance of discretion in financial risk management. If we only look at legislation and regulation, which I promise you, if you open any one of these books in this room, that's where the focus is going to be if they're talking about financial industry development. What is the law that's enacted, and then how does that law shape the banking system? Or how does financial crisis lead to certain laws being enacted or certain regulations coming online? What the book is really trying to do is say discretion has been a fundamental part of this process from the beginning. But certainly, it can be used for good or ill, right? It can be discretion can have good results and bad results. And so that, I think, is recognizing that with changes in administration, we can move very quickly into a version of regulatory capture where the president might say, I really favor the oil and gas industry, and I want supervisors to go into banks and instruct them. Wait, there we are again. To make certain kinds of loans, right? You can imagine that level of discretion. Or, we want examiners to criticize loans for wind farms because we don't like wind farms. That's possible within the system. You can then imagine legal challenges to it. But I guess what I would say is that finance does evolve, and you want financial risk management to evolve. Legislation is slow. It's imperfect. Regulation is slow and imperfect. So having some residual system that's there to respond is ultimately beneficial. But, it has its own risks. It has its own challenges. And that's why being able to observe it and critique it is really important. And so when it happens behind closed doors and we don't know what supervisors are telling banks, that's really where you lack that accountability. And so I say discretion without accountability, that is a problem.
Well, just about this time last year, we showed It's a Wonderful Life, which features a bank examiner. There's not many movies that feature a bank examiner. I think his last line of the bank examiner is, I better go, I'm hoping to spend Christmas with my sister in Elmira. We better let you go to spend time with your family. It's been wonderful. The book is really well written, and it's hard to put it down, actually, because it flows so nicely. So congratulations on that. I wish you'd written it in 1990, so I could have better understood the structure of the whole system and all these regulatory layers, but it is now available for anybody who's interested in banks. We are selling it at the back of the room. Drinks are provided, as ever, by our friends at Kennox Asset Management, and thank all of you. Please bring your empties to the back of the room, I have to say that, and please join us for a drink, and thank all of you for coming, and please thank Sean.
Thank you.